I want to take a look here at interest rates. Back in the beginning of the year, at our New Year's show, we gave our projections for all of the markets, and we're going to just review this a little bit and give you a sense for what is going on and what our projections are right now. We're going to look at ZNs, that's the 10 years, on a monthly chart, and we're going to look at TNX on a monthly chart just to give you a sense of what we believe is likely to happen and how we did so far on what we were looking at. So this chart right over here is a cycle chart. For those of you that are brand new, this may be the first cycle chart you have ever seen. What we're looking at are the rhythms of the market. Essentially, cycles, all of these squiggly lines, are just a visual way to see money flow. And you can learn so much about market condition by understanding this. There are many aspects to cycle analysis, and you can learn about cycle analysis by going to our website and click on Cycle Analysis Workshop. There's an introduction video there and some other information about the workshop that we have so that you could learn this style of analysis. So what we have here is, well, for 2021, our projections were that a high would come in the first quarter for the year. Well, here's your first quarter for the year, so that sure looks right. The expected range in the ZNs were a 139 high, so the high for the year, when you look right over here, was about 138. The expected low was about 129, so that comes down here to that 50%. You can see that right there, and it's still the same thing that we're looking at right now, and we thought it would end near the lows. And the bond market, we believed was in a bear and was confirmed when it got below that 136.22 level right over here on the 10 year. So we believe it's a bear market. This yellow oval right over here and this yellow oval right over here are very important because what they illustrate is what's called a left-hand translation. That's when the cycle rally comes as it's supposed to, but then peaks on the left side of the cycle and leaves a lot of time to fall. These numbers over here are the lengths of the cycles from low to low, and every cycle is measured from low to low. And in this case, the 20-month low came right over there, and you had only a 2-month high, and then it broke down. This was an 18-month low and a 2-month high, and then it broke down. So that's a very negative condition when that happens. Our projection now is for a decline to about this 129 area, best case through the end of the year. That would give you about a 182 yield were that to come. And again, we were looking for about a 190 yield, so that pretty close to that. And were it to be able to break down to the 61.8, about 126 on price, you'd have a yield approaching the 220 area. And believe me, were that to happen, the stock market would not like that at all. It already doesn't like what's going on, and investors are starting to look at this and get some sense of danger. So here we are only now about 9 months into this cycle. That leaves another maybe 8 to 12 months on the downside in here, and that takes you potentially into early 2023. That shows you a lot of trouble, as we have believed, in the bond market. So now we're going to look at it in yields, and I'm going to put up the TNX chart right over here. And this is really cool because I've shown this chart a couple times to our membership, and I think once out here in the public. And what these green zones are the periods where yields rally. And you can see these are called nested areas on the cycles right over here. So when the declining phase comes to an end, you get into a bottoming phase and a rally. You can see the beauty in these cycles right over here as the low comes here and the low comes here and the low comes here, and the rally phase clicks big on the upside. So the 50% level on yield right here is about 182. This 61.8% is about 2.12 approximately, and if it really got crazy, this is about 2.65, up at that 78.6%. You can see we have all three potential projections up there, and this rising phase right over here soon to end and then go into a corrective phase. You can see that right over here where you had a rally and then a minor and then another big spike up. You can see that right over here where it declined pretty sharply, and that happens when you're in a big declining phase. Now, the question is, if we're now in a bull market in yields, bear market in the bond market, then all of this will make a big base. In other words, you'll have a rally, yields will go up, it'll pull back down over here, and then it'll be moving sharply higher again after that. But this goes way out into 2023 over here. This is showing you that we believe that there will be upticks in the yield market well into 2022. And that is a problem for the stock market for sure when we look at that. So the potential is for rates to continue up into early 22 to 182 to 218 are really the yield prices we're looking at. And if that happens, the Fed will be pushed. Prices are already pushing their hand. We saw what happened in the Philly Fed. They're in total denial. They don't want to break the bubble that they have created. So they are trying to ignore this. They're looking the other way. They're just simply a horse on the track with blinders. And that is potentially not going to be able to remain if the markets keep pushing their hand, and we think it will. Stock market will likely be well into a bear market by the time we get up into these prices over here, as we believe that the second half of the year is a problem for the stock market. And investors are starting to feel it. They're starting to get ahead of the Fed by pushing the rates up the way that they are. And we really believe that that will bleed over into the stock market into the second half of the year. So again, we're looking for rates to maybe stall here at 182, pull back a little bit somewhere over here, and then be spiking on the upside again. That is a look at the 10-year treasuries on these beautiful, beautiful cyclical rhythms that you see right in there. And of course, our level 4 members can have any of our charts and all of the work that we do. So I wanted to just remind you all of that. So level 4, advanced trader level, that gets all of our charts for the Thinkorswim platform. TDA, our preferred broker. And if you want to open an account there, please do it through our website link right on the front page. So that is a look at interest rates, the longer term view, and the review of what are very solid projections that we did at the beginning of the year.